Hello everybody, welcome to another video. In this video, we're going to dive into how to spot highly likely reversals in the market. When I dive into the markets and look for areas where price can likely reverse, what is the number one thing I am looking for? The answer is draws on liquidity. There has to be targets in price, whether it's to the upside or downside, that make sense for price to gravitate towards at a specific period of time. There has to be some highs or some lows that price can definitely gravitate towards. I want to see price sweep a low, and if there's highs above that make sense, I want to see it then distribute to those highs. So let's look at this example here to begin. Price came, swept this low, swept sell side liquidity here, filled this new week opening gap, and from this point, the question becomes, will price continue going lower, or are there reasons for price to reverse? And what do I see here coming into this day? Well, as you can see, first and foremost, we have pre-AM equal highs that formed, as well as several highs here going up to London highs right over here. So off the bat right there, it makes sense for price to want to move higher. There are draws on liquidity right here for price. We've created lows, left behind highs. We've swept this low, filled the new week gap with equal highs above and London highs above. Several highs in this vicinity. So it makes sense for price to start taking highs. So from that point, I go on the lower time frame and I look for an area or an entry that makes sense for price to take those highs. As you can see, look at all these highs here. All those highs here, all those highs here on the lower time frame, all these highs here, lots of liquidity to the upside. It would make sense if price wanted to come for these highs. We swept the low, internal sweep as well. I'm looking for an area to go long. Waiting for a confirmation. And I mean, as you can see here off the bat, we inverse this gap right here. Right here, inverse this gap. We inversed this lower time frame gap as well, and we are in that one as well. It would make sense to enter right here. If you want to wait for the change in the state of delivery, you can wait for that as well. It depends how risky you want to be with your entry. So let's say we want to take the inverse gap, we can enter right here. You get the confirmation, internal sweep there, and you would target, number one, the equal highs above that formed, and secondly, the London highs. Because all of these highs above can be taken out, and it makes sense for price to do so. So right there, that could be an entry. If you want to wait for the change in the state, and that's more comfortable for you, you would enter on this candle here. Both work. So from that point, enter on the inverse gap of 4.17 risk to reward, and let's see what price does. We swept the low, we filled the new week gap, we left equal highs above, we left London highs above. On the lower time frame, lots of highs above, so there are draws on liquidity to the upside. On the lower time frame, when you see that reversal, we get the V-shape inverse gap, we get the change in the state of delivery as well. You have confirmations to go long. And let's see what price does. There's TP1. And there's full TP right there. So just like that, we get a 265 point move, equal highs taken first, and then the London highs as well. This is how you spot those highly likely reversals. Where does it stem from? From the 15-minute when you go and you look at the equal highs, several highs above, London highs above. It just makes sense. What do? We filled this new gap right here. Filled it, swept the 50-minute low, left highs above, equal highs, all those highs. I go to the lower time frame after the sweep, I get that V-shape, inverse gap, change in the state after entry there, equal highs taken, London highs taken, and that's how you catch those highly likely reversals to maximize those moves. All right, so here's another example of how you can spot those highly likely reversals in the market. Staring at this area right here, what do you see in price? What do we have? We have, number one, as you can see, equal highs resting above right here. We have that range that formed. We have equal lows that formed right here. And we're delivering outside of this 15-minute bullish imbalance right here, as well as this 15-minute inverse gap right there. So we're delivering out of that. We have equal lows below. We have equal highs above. We have equal highs here as well. So there is reason to expect price to head to one of these points. I would wait for us to either take the lows, take the highs, one or the other, and then try and catch a move. So we're approaching market open, and let's see what happens. As you can see, like I said, we have draws above for price to gravitate towards. It would make sense if price wanted to come for those highs. Also, side note, we've dumped quite aggressively in the previous day. And so it would make sense if price wanted to capture some ground back. Heading into market open, we look to see what price does. 9:30, we tap into that 50-minute gap. No entry there to take. And we come and take the equal lows. So equal lows have been taken right there. So that's that. Equal lows taken. My eyes immediately go to these equal highs. What else do we have? Well, look, let's break it down here. Just on the lower time frame, 1, 2, 3, 4, 5, 6, 7 here, beyond 8, 9 highs just right there. Looking at it right there. 9 highs for price to gravitate towards. It would make sense if price wanted to reverse and start taking those highs and deliver from that sweep of sell side. Catch that reversal all the way to the highs above. And you have that accumulation. We have the range highs. It would make sense if price wanted to reverse from that point. We wait and see if price gives us the confirmation, and bang, just like that. Complete V-shaped reversal right here. Inverse this gap right here. V-shaped reversal. And from this point, I would look to enter right off the bat. Enter on the inverse gap. Stop below the low. And target those equal highs above. That right there makes sense for a 2-to-1 R. That right there makes sense. We would enter on the retest right there. Over 2-to-1 R, delivering out of that 50-minute, swept sell side liquidity, and we have the equal highs above. That's what I would look for right there. And as you can see, price then shoots all the way up, takes those equal highs. You don't have to catch a complete full move beyond it. You could take a piece of the pie. Why would I get out here? Because that's what I want to target. There's lots of liquidity to the upside. So step one is, are there draws on liquidity to target? The answer here is yes. And so as you can see, we wick below, take the equal lows, still respect that 50-minute bullish imbalance, that 50-minute inverse gap right here, deliver out of it after sweeping the equal lows with clear equal highs above from previous sessions, like London session, and we go on the lower time frame after that sweep, V-shaped reversal, inverse gap right here. That's the entry right there, targeting the equal highs above, and we catch a beautiful 2-to-1 R. Following the game plan to catch these highly likely reversals in price. All right, here's yet another example of how you can spot those highly likely reversals in the market and catch them to perfection. So for this example, let's recap what price has done now heading into the AM session. As you can see, London session, we expanded, took the equal highs here, relative equal highs here, took all that liquidity to the upside, expansion, consolidation, expanded again. So we began to expand again after this accumulation here. What do you notice here in price? What have we done here? Well, one thing you have to note is that when we accumulated here, we didn't come back for the low that started the range. So the range low hasn't been taken. We didn't manipulate those lows. We just expanded off that point. So this could be a potential area for price to retrace to. Now, is that enough? No, you would look for additional confirmation. So we'll mark that high out if price wants to come take that high. And then we go to the lower time frame and say, okay, would it make sense if price wanted to come back to this accumulation? So as you can see, here is that huge range we have here, that huge range. As you can see, range low never taken here. All these lows that formed in this range were never taken. The highs obviously were taken in this move up. So could we come back and return to these lows? Well, what do we notice here? All along this area, relative equal lows right here. So it would make sense if price wanted to come for the lows. We have relative equal lows and we have low resistance liquidity right here. Low resistance. Just in this here, ignoring even the lows all here, which you could take into account as well. But just counting these lows, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 lows just right there for price to gravitate towards. And so as you can see off the bat, at 9:30 market open, price comes, takes that high, and look what it leaves behind. Lows all here, low resistance liquidity all here, right here, low resistance right here. And it matches with the PO3 type move that we manipulated the range, and we can come and expand and distribute back down into this range and take all of those lows for people who went long and have their stop losses resting below. So the number one thing you look at is liquidity. Is there reason for price to head there? And the answer is yes. There is reason for price to head here. So we're waiting to see. And what do we get here in price? Well, first and foremost, we get this inverse gap right here. Right here, price swept liquidity, V-shaped reversal, inverse gap right here. This is the riskier entry you can take. It depends what your approach is. If you want to take the inverse gap, V-shaped inverse gap, that's the entry that's usually first. If you want to wait for the fair value gap, you'll get those sometimes. If you want to wait for a change in the state of the delivery, your entries will likely be less effective in terms of R to R, but they will be much more of a confirmation and much safer. So you pick your poison with what you want. Let's say you want the inverse gap entry right here. You would take it right there. Bang. That's your entry right there. 3.35 risk to reward. Now, let's say you wanted to take, I'm going to give you guys options here. Let's say you wanted to take the change in the state of delivery / breaker entry. Well, that would be right here. And so your trade would look something similar to this. You would enter right here. Stop would go above the high of the candle and then target the equal lows there. Now, the risk to reward is around a 1.8, right? 1.8, 1.9. But you get that confirmation. So you get two options here because this is the breaker formation that we get. Now that's the V-shaped inverse gap. You enter there, 3.35 risk to reward. And as I said, what's the basis of this reversal? The liquidity. There is reason for price to head to these lows. The damage has to be done. And so when you get the confirmation, you get the sweep. That's your entry. And let's see what price does. And bang. 103 points, just like that, using the draws on liquidity at hand to your advantage. Like I said, low resistance liquidity. As you can see, we accumulated, manipulated, and distributed back to this range low. As you can see, range low right here eventually gets taken. You could have targeted that as well. I'm giving you guys options here to see just how diverse this can be. And so this is the basis, I'll break it down for you, of the PO3. This is the accumulation leg. This right here is the manipulation leg. And this right here is the distribution leg, which is typically what you want to capitalize on. So we get accumulation, manipulation, distribution back to the range low. This happens every single day in the markets. You compare this with the sweep of liquidity with the equal lows below. You pair that with the low resistance liquidity here, and you catch those highly likely entries, those highly likely reversals. You typically want to be in that distribution leg. And so that's what we were here, as you can see, to a T. You catch that move, equal lows all here to begin, low resistance here, equal lows at the bottom. It all makes sense to catch a highly likely reversal there. So I hope this was insightful. I wish you good luck, good trading, and take care, everybody.